Welcome to Talk Tickers. We're the podcast that cuts through the noise of earnings calls to bring you the insights that experienced investors need.
And today, we're diving deep into 3M, specifically their first quarter earnings for 2025.
Right. And the headline seems pretty strong, actually.
Yeah, it was a solid quarter. Adjusted earnings per share came in at $1.88. That's up 10% year over year and definitely better than expected.
Okay, $1.88 adjusted EPS, up 10%, and top line.
Organic sales grew 1.5%. And importantly, that growth was positive across all their business groups. No major weak spots there.
That's good to see. Any movement on margins?
Significant movement. Operating margins jumped 220 basis points compared to last year. That's a pretty healthy increase.
Definitely. And cash flow.
Solid. Free cash flow was around $500 million, so about $0.5 billion.
Okay, so strong numbers, but they did mention achieving this amidst a, quote, dynamic macroeconomic environment.
Right. Which leads to the guidance. Despite that strong Q1, they're keeping their full-year adjusted EPS guidance the same. That's $7.60 to $7.90.
Before tariffs and any offsetting actions, I assume.
Correct. Before that impact, they're citing that macroeconomic uncertainty as the reason for, holding steady on the outlook for now.
Makes sense. So let's unpack what's actually driving these strong Q1 results then. You mentioned growth initiatives.
Absolutely. A key focus seems to be speeding up new product introductions, getting more innovation out faster.
How's that translating into actual numbers?
Well, in Q1, they launched 62 new products. That's a big jump, or roughly 60% more than the same quarter last year.
60%? That's quite an acceleration.
Yeah.
Are they actually hitting their launch deadlines?
Apparently, yes. They said their on-time launch attainment improved to over 70%. So it's not just more products, but getting them to market more reliably, too.
Okay, so the execution is improving alongside the volume. What about the pipeline looking forward?
It looks healthy. The target is 215 new products for this year, and they have a kind of longer-term goal of 1,000 new products over the next 3 years.
1,000 products. Wow. Are these new launches actually contributing to sales yet?
They are starting to. Sales from products launched in just the last 5 years were up 3% in Q1, and they're aiming for that contribution to grow to over 15% by the end of this year.
So the momentum is building there. Can you give some examples? What kind of products are we talking about?
Sure. Q1 saw things like the Scotchbley ProShart Painters tape that's on the consumer side.
Okay.
Then there was a low sparkle optical film for notebooks, hitting the electronics market.
Yeah.
And a new solid-state drive connector for data centers, so pretty broad.
Yeah, it covers a lot of ground. Okay, beyond new stuff, what about optimizing the core business? They talked about commercial excellence. What does that actually mean?
Yeah, it's kind of their umbrella term for sharpening operations. Think standardized operating rhythms, better goal setting for sales teams, and tighter governance around pricing, getting more discipline.
So more rigor in the day-to-day sales process.
Exactly. They mentioned tripling the number of structured reviews between sales managers and reps, really drilling down on performance.
And relationships with big customers.
Also a focus. They've completed over 100 joint business plans with major customers. Trying to align strategies,
Makes sense. And cross-selling, leveraging that broad portfolio.
Definitely. They've built up a cross-selling pipeline now worth over $40 million, looking at 23 specific product pairings.
40 million just in identified opportunities.
Right. And the target is to grow that to $100 million across 50 pairings by 2027. So they see real potential to sell more stuff to existing clients.
Are they using tech to help with customer retention?
Yes, they mentioned deploying a predictive analytics tool. The idea is to spot accounts that might be at risk of leaving and intervene proactively.
And is this translating into orders?
It seems so. The average daily order rate was up over 2% in Q1, and they said it actually accelerated in March. Higher
order rates usually mean a growing backlog?
Correct. Their company-wide backlog is up in the low teens since the start of the year. That gives them about 25% revenue coverage for Q2, a decent cushion.
And can they deliver on those orders?
Right.
What about fulfillment? Big improvements there, apparently. On time, in full delivery, OTIF hit 89%. They highlighted that as their best performance in the last 5 years.
89% OTIF. That's quite good for a complex operation like theirs.
It is. Consumer and transportation electronics are actually above 90%. Safety and industrial is a bit lower, approaching 82%, but they're targeting 90% there by year end.
And factory efficiency. Any metrics there?
Yeah, they track overall equipment effectiveness, or OEE. That's up to 58% now.
Okay.
And it's deployed on 191 key assets, which cover about half their production volume. So they're getting more out of their key machinery.
Good. And safety, always important for an industrial company.
Right. They reported the incident rate was down 25% year over year, continuing progress towards, an injury-free workplace goal.
Okay, let's shift to the financial side. Capital deployment, what were the highlights?
Well, first, they refinanced about $1.1 billion in debt, strengthening the balance sheet a bit.
More interesting for shareholders probably is the return of capital. They sent back $1.7 billion in Q1 through dividends and share buybacks.
$1.7 billion back to shareholders. Did the dividend go up?
It did, a 4% increase. Signals some confidence, right?
Usually does. What about buybacks for the rest of the year?
They actually increased their expectation. They now plan to repurchase $2 billion worth of shares this year, up from the $1.5 billion they initially guided.
Okay, so leaning more into buybacks, total authorization is $7.5 billion, you said?
That's right. So they have room to do more if they choose.
Any movement on selling off parts of the business? Portfolio shaping?
They mentioned one small divestiture was recently signed, but they also said progress on other potential deals is slow right now.
Why slow?
Primarily due to trade policy uncertainty. Makes it harder to value businesses and get deals done, apparently.
Yeah, that figures. Okay, let's break down the performance by business group. How did safety and industrial do?
Grew 2.5% organically. They saw good demand in things like cable accessories, industrial bonding solutions, electronics bonding, and personal safety.
Any weak spots in S&I?
Yeah, the auto aftermarket business was down. They attributed that to lower collision repair claim rates, fewer accidents needing repairs, basically.
Okay. What about transportation and electronics, T&E?
That was up 1.1% adjusted organically. The real driver there was double-digit growth in aerospace.
Aerospace continues to be strong. Offsets?
Partially offset by lower demand in electronics generally, and also some weakness in the auto OEM market, selling directly to car manufacturers.
Got it. And the consumer business.
Yeah.
The Post-it notes and Scotch tape side of things.
That was up just slightly, 0.3% organically. Growth came from filters, respiratory products, paint protection films, auto care.
But offset elsewhere.
Yeah, offset by softer consumer spending in some of their other categories. Kind of a mixed bag reflecting the general consumer environment.
All right. So looking ahead, how does 3M see the rest of the year playing out, especially given that macro uncertainty?
Well, they acknowledge the outlook has softened a bit. Market forecasts for consumer spending, auto, electronics, they've all come down.
What's their internal forecast based on that?
Their own blended GDP industrial production growth estimate for 2025 is now 1.8%. So lower than maybe previously thought.
But they still think they can beat the market.
That's the plan. They expect to grow above that macro level, citing those commercial excellence initiatives and the new product flow we talked about.
Okay. Confidence in their own execution. How does that translate to the margin outlook?
Because of that softer market, they're now saying they expect to trend towards the lower end of their 2-3% operating margin expansion range for the year.
But didn't Q1 beat expectations? Doesn't that provide some cushion?
It does, and they did acknowledge that. They said the strong Q1 performance suggests there is potential upside, maybe getting them back towards the midpoint of their margin and earnings guidance. So a bit of caution, but acknowledging the good start.
Okay. Any other puts and takes on the full year outlook? FX. Interest.
Yeah, foreign exchange is actually looking a bit better for them now. Less of a headwind than they initially thought.
Oh, interesting. By how much?
They didn't quantify the exact Q1 benefit, but for the full year, they now see FX as maybe a 15-cent headwind, improved from 20 cents previously.
Okay, so a nickel improvement there. Is that offset anywhere?
Partially, yeah. Offset by costs from share option exercises and slightly higher net interest expense.
Got it. And the timing of earnings through the year. Still expecting an even split.
Yes, roughly equal split for sales and EPS between the first half and the second half. And they still expect about 100% adjusted free cash flow conversion for the full year.
Okay, now, the elephant in the room for many global companies. Tariffs. How big of a deal is this for 3M?
It's potentially significant. Their estimate for the annualized impact before any mitigation is around $850 million.
Wow, $850 million potential hit. How much do they expect to actually feel this year in 2025?
Because of inventory lag and timing, they expect about $400 million of that to impact results this year. They estimate that's roughly 60 cents of EPS.
60 cents. That's substantial. What are they doing to fight back against that? What's the mitigation plan?
It's a multi-part strategy. First, ongoing cost-cutting and productivity efforts. Second, optimizing their production and logistics, maybe shifting where things are made, leveraging their U.S. factories more.
And pricing.
And third, selective price increases where it makes sense. They're aiming to get that net impact for 2025 down from 60 cents to somewhere between 20 and 40 cents per share.
So potentially cutting the impact by more than half through mitigation. Did they see customers rushing to buy before tariffs hit? Any pre-buying?
They said minimal pre-buy activity, actually, particularly in China, ahead of the increases.
Interesting. What about order patterns since the tariff announcements? Any immediate changes?
It's a bit mixed. Industrial orders apparently stayed strong into April, but they did see some softening in transportation and electronics. Consumer usually starts Q2 slow anyway, they noted.
And they feel they have the flexibility to adjust production if needed.
They emphasize that. They have, 110 factories, 88 distribution centers, and current utilization is around 58%. So theoretically, they have capacity and options to shift things around.
Any signs of anti-American sentiment affecting purchasing decisions in places like China?
They said they haven't observed any significant behavior like that yet.
Okay. When do they expect the biggest tariff pain point during the year?
More heavily weighted to the second half. That's mainly due to inventory levels. They'll work through existing inventory first before the higher tariff costs really flow through.
And the pricing actions, are they just blanket increases?
No, they stressed it would be strategic, surgical, often discussed with customers, not just across the board hikes.
If the tariffs caused any actual supply chain breakdowns for them yet?
No significant disruptions reported so far.
Okay. One last bit on outlook at those specific end markets. Auto and electronics forecasts have come down.
Right.
How is that hitting 3M's expectations?
Yeah, the auto build forecasts, especially for the US and Europe, have been revised down quite a bit for 2025. As a result, 3M now expects its own auto OEM business to be down mid-single digits for the year.
And consumer electronics.
That market is now expected to grow only low single digits, slower than previously thought. So those weaker end market forecasts are baked into their overall guidance now.
Got it. What about margins within the segments for the full year?
They expect margin expansion across all three business groups, safety and industrial, T&E, and consumer for the full year 2025.
Even T&E, despite the Q1 softness.
Yes, although they noted T&E margin was lower in Q1, which they expected. That was due to some stranded costs from a prior divestiture, higher investments, and a less favorable mix compared to a really strong Q1 last year in electronics.
But SIG and consumer margins look good in Q1.
Yeah, safety and industrial and consumer saw healthy margin expansion in Q1, and they expect that trend to continue through the year.
Are these efficiency actions ongoing or just tariff related?
Very much ongoing. That focus on operational excellence, improving OTIF, OEE, productivity, quality costs, that continues.
Has the tariff situation maybe spurred more efficiency efforts?
It seems like it. They mentioned the tariff work is giving them deeper insights into the business and highlighting new opportunities, potentially even in G&A general and administrative costs, like centralizing external services.
Okay. And you mentioned Forex quickly, just to confirm the latest outlook.
Yeah, the headwind for the full year is now expected to be around 15 cents per share. That's better than the 20 cents they expected previously. And, if the U.S. dollar weakens further, that could potentially improve even more.
Okay. And China specifically, how big is it for them and how's it doing?
China's about 10% of their total business. It actually grew double digits last year, and growth was mid-single digits in Q1 this year.
Still growing, despite everything.
Yeah.
Are they looking at sourcing shifts related to China tariffs?
Yes. They're exploring opportunities to maybe shift sourcing to mitigate the impact of tariffs on exports from the U.S. to China. For instance, maybe shipping more from Europe to China instead of from the U.S., using that global network again.
Right, leveraging that footprint. Okay, fascinating detail there. Now let's shift to our favorite segment. This is not financial advice. Time for some outrageous but plausible trade ideas based on this 3M call. What's on your mind?
Okay, idea number one, focusing on that operational flexibility we just talked about. Given 3M's huge manufacturing network and their stated ability to shift production and sourcing to dodge tariffs, well, maybe the trade isn't 3M itself, but a long trade in companies that are kind of the opposite companies, heavily reliant on single-source manufacturing, especially in regions facing tariff heat.
So betting against the companies that can't adapt like 3M might be able to.
Exactly. If 3M navigates this successfully because of its diverse network, its relative performance could shine compared to less agile competitors. It's basically a bet on operational adaptability being a key differentiator in this fractured global trade world.
Interesting. A relative value play based on operational agility.
Yeah.
Okay, what's idea number 2?
This one focuses on that new product cycle. 3M is really ramping up launches, getting better at hitting deadlines.
Right, the 62 new products in Q1, aiming for 215 this year.
So the contrarian idea here could be a short opportunity. Look at established players in 3M's key markets, think industrial adhesives, electronic materials, that sort of thing, who maybe aren't innovating as fast. Companies showing slower R&D spend or fewer new product cycles.
So you're betting that 3M's new stuff will actually disrupt the incumbents?
Potentially. If this flood of new 3M products performs as well as they hope, it could definitely eat into the market share of players who are standing still or moving slower. It's a wager on accelerated innovation, winning against, incumbent inertia.
Okay, 2 very different angles there. One betting on the value of flexibility, the other betting on the disruptive power of innovation. Definitely food for thought.
Outrageous but plausible, right?
Absolutely. Okay, that wraps up our deep dive into 3M's first quarter 2025 earnings call. We've unpacked the results, the strategies, the headwinds, like tariffs.
And hopefully given you some valuable context. But remember, this is Talk Tickers. We provide information and analysis. This is definitely not financial advice.
We'd love to hear what stood out to you. What do you think about 3M's tariff plans or their big push on new products? Let us know.
And for further exploration, definitely check out 3M's own investor relations materials and maybe compare their performance metrics against some key competitors in the industrial space.
Join us next time on Talk Tickers, where we'll be dissecting another crucial earnings call.